Hey, this is Tom, and in case you're new here, I used to be a financial analyst. Now I'm a full-time YouTuber, and I'm here to talk to you about the stock market. And specifically, in today's video, I'm going to show you a company that I believe is about 86% undervalued, even with the most strict conservative assumptions I could think of. Now, as always, the bottom line in my videos comes first, so I'm going to tell you which company, how much it's overvalued, everything. And then if you want to stay for the full analysis, you're more than welcome, but I do respect your time, so I'm going to give you the bottom line first. Now, before we get started, don't click nothing, don't smash nothing. There's no need. Just watch this and listen. Now, the company I'm talking about is Vale, the Brazilian company. Vale is actually a miner that engages in mining expensive shit from the ground. But the most important thing is that I believe in the current structure, their share is about 86% undervalued. So we can see a lot of upside as long as there's no major catastrophes that are going to impact their business. Obviously, this is a very risky business. We're talking about mining, so a lot of work shortages or regulation or natural disasters or even spikes or basically spikes downwards in the price of the stuff they dig up from the ground. So there is risk involved, but assuming you can manage the risk and you can mitigate, I believe there's a huge amount of upside in this company, and I'll show you my DCF as well as their financials, as well as their numbers, everything I think you need to see to start researching this to make a decision, because I'm not a financial advisor. This is not financial advice. I'm just sharing with you my opinion. And I think the next step for you is, after you watch this video, is actually you do your own research and make your own decision if this is a good investment for you or not. Thank you.
My name is Tom Nash, and I quit my corporate job as a senior financial analyst to break down companies for you. If there's one thing you need to know about me, I don't take bullshit from anybody.
So right now on the screen, you're seeing Vale, and it's safe to say that the last 6 months were not a good time for Vale. We're talking about 36% loss of share price in 6 months. It's kind of insane. 62 billion market cap, and as you can see here, an insane dividend yield. Almost a 17.6% dividend yield, one of the highest you can find in the market, which I think is really impressive if you're into dividend stock as well. So let's look at profitability. This is a company that generates 63% EBITDA and 31.6% net income margin. These margins, for somebody who's not in SaaS, are pretty much to drool on. This is monopoly money. The margins are phenomenal. 31.5 cents on the dollar is really impressive. The other impressive thing you're going to look here is the growth. This is a company that grew by 77% year over year. They are expected to slow down, but still we're looking at another 7.5% growth next year, and so forth and so forth. You have to understand that digging shit up from the ground in inflationary times tends to be quite lucrative because people need more shit. I mean, it's kind of basic. You don't need to do a lot of math. As far as the valuation goes for this company, again, very cheap. Look, price to earnings current 12 months is 80% undervalued at 3.7. EV sales, this is ridiculous, at 1.23. 31.6% undervalued. EV EBITDA is 1.95, 80% undervalued. And price to sales is 1.17, 25% undervalued. So by almost any metric, this company is insanely undervalued. But wait, I'm still going to show you the DCF. I do want to show you this. I'm not really hard into dividend stocks, but I mean, their payout ratio and the yield is just insane. Almost 18% dividend yield. Quite insane. Very good. As far as the financials go, they're really fluctuating with the price of the stuff they're digging up from the ground, as you would expect. So you can see a lot of fluctuation in the revenues. But at this point, they're at an all-time high, I think, or at least for the past 10 years. The closest they came was 2011. So $55.5 billion. If you look at the balance sheet, again, you'll find really a company that's run in a very strict manner. You can see here total cash and cash equivalents of 12. And if you take a look at the balance sheet, you're going to find $12.5 billion in total cash and investments. As far as the debt goes, the total debt, I believe, is 18.6. So they're slightly debt negative, which means they have more debt than cash by about 6 billion. However, if you take a look at their assets to ratio, you can see that the total assets are 86.7 billion right here. And if you scroll down to the total liabilities, you'll find the total liabilities are 52.7. So they have about 30 billion of gap of assets over liabilities. So whatever they have in cash can be supplemented by these 30 billion. So they have no problem repaying their debts. That's kind of a given. And here's the DCF for this company. 22.5 billion in 2021 and a 5% annual growth every year for 5 years. So well below the expectations. Also effective tax rate of 18%, which is what they're paying, and $50 billion in capex, which is way above what they're spending right now. And I used a discount of 12%, which is, as you know, 2% higher than the discount rate I usually use for the risk, the extra risk that this company poses, just to give myself an extra cushion. 7.6% multiplier, very low because of their industry mining, and a 4% perpetual growth. And as you can see right here, we use extremely conservative assumptions, really high discount rates, very low growth, and we got to $23.8, which is 87% higher than its current share price, even under these strict circumstances. So I see a lot of potential in this company. Although, as I mentioned earlier, you still got to do your research because I'm not a financial advisor. That's just my opinion. So go ahead, do your research. And this is from the main page of TipRanks. By the way, there's a link for you to join TipRanks with a 10% discount. I'm affiliated with them, but I've been a paying customer for ages, even before I had an affiliate link. I love their stuff. So Vale currently is looking at 17.2, which is actually my DCF valuation for the analysts, and current price is $12.88. So we have a huge gap here. And if you look at the analysts that are covering this stock, only the 5-star analysts, you have really only 5 good analysts, and outside of one, all of them have massive upsides for the stock. One is actually higher than mine, but the other one is exactly with me, and one more that's at 16 and 40%. But I mean, in general, you can see a lot of positive notion toward this company coming out from the analysts. And as always, I just want to say huge thanks to the channel members and the patrons. If you appreciate this video and you want to watch more, I'm going to put another video right here so you guys can check out. And also, thank you for the members. Thank you for the patrons. Your support, $5 per month, makes me able to do these videos, which are not really clickable, but provide, I think, a lot of value. If you want to join, $5 per month, the links are below. I'll see you tomorrow.